The American economy lost jobs last month, 23,000 of them, when Wall Street was expecting a gain of 80,000. So why did the S&P 500 close at a record high on Friday? Because this was the week bad news became the best news of the year. Let's run through a summary of what happened during the last week in the market. The week ending Friday, August 7th, 2026. Welcome back to the Week on Wall Street from Wallstreetholics, your place for research and education and not financial advice. 4 things drove the markets this week, and they are all one story. Payrolls collapsed and rate hike bets collapsed with them. Oil bled its war premium, which in turn pulled inflation fear out of the picture. And crucially, the rally was broad. Small caps came along for the ride. Let's walk through the data, the Fed, the bond market, and what Wednesday could do to all of it. Here is the entire week on one page. The S&P up 3.6% to a record 7,757. The Nasdaq up 5.2, its best since April. Yields lower right across the curve. The dollar down, gold and silver sharply higher, and crude down more than 7%. Everything green except energy, but energy's fall is precisely why everything else was green. Manufacturing releases were strongly featured on the calendar, the ISM index at 55.6, the best reading since 2022, but every single labor indicator went the other way, and one number should worry you more than the rest. Services prices paid rose to 70.3. A cooling jobs market with sticky service sector inflation is one of the hardest hands a central bank can be dealt. This is the print that moved everything. Economists wanted 80,000 new jobs. We got minus 23,000. But the bar on the right is the real story. May and June were revised down by 103,000 between them, which drags average monthly hiring down to roughly 34,000. And the unemployment rate only fell because people stopped looking for work. Some context. 9 days before this report, the Fed held rates for a 5th straight meeting, and 3 officials dissented because they wanted a hike. Then Friday landed. September hike odds fell from 67% to 42%, but read that carefully because nobody is pricing cuts. Markets simply pushed the next hike out toward December. That is a delay, and certainly not a pivot. The bond market's response was clean, and it is worth understanding. Yields fell 9 basis points at the 2-year and 9 at the 10-year, but the gap between them finished exactly where it started, at plus 45 basis points. In a genuine recession scare, that curve steepens hard. It didn't. So this was the market repricing the timing of Fed policy, not an assessment into the health of the economy. Commodities split hard, and the split explains the week. Brent fell 7.3% as Iran and Oman moved toward reopening the Strait of Hormuz, and cheaper energy means lower inflation expectations. That money went straight into metals. Gold rose 7.4%, its best week since January, and silver climbed more than 10%. Here's the most important takeaway of the week: precious metals beat stocks. The dollar took the hit, sliding to a 3-month low with the euro at a 7-week high. A falling dollar alongside rising stocks is textbook risk on, and it is part of why metals ran so hard. Crypto, though, barely showed up. Bitcoin gained 2.4%, is still down 24% this year, and sentiment sits at extreme fear. And next week will be telling, with the Clarity Act due for a vote. Leadership snapped straight back to semiconductors. The chip index gained more than 8%, and Nvidia alone more than 10%, as fears about AI spending eating into cash flow quietly faded. On Friday, utilities and property joined in on lower yields. The laggards were the mirror image. Energy gave back its July leadership as crude oil sank. If you remember one image from this video, remember this ranking: silver and gold. Assets with no earnings, no growth story, and no AI narrative outperformed every single equity index in a week. The Nasdaq gained 5.2%. That is not a growth bet. That is the market betting the Federal Reserve has to stop. Palantir led the winners on a blockbuster quarter and a raised outlook. Boeing had its best week since April after finally winning FAA approval for the 737 MAX 7. On the other side, HubSpot fell 20% after cutting full-year guidance, its worst single day in 12 years, and SpaceX swung from minus 13% on Wednesday to plus 12% on Friday. Globally, this was mostly a Western story. Europe arguably matched America. The StoxX 600 closed at an all-time high, its fourth straight record, with the DAX up nearly 3%. Asia largely sat it out, and the Nikkei actually slipped on Friday. China was the exception, rising after July export data beat expectations. 4 quiet signals worth your time. Breadth genuinely improved. Advances beat decliners 2-1, so this was not just mega caps. The yield curve refused to steepen. Services prices actually rose, so inflation is not dead. And nearly 1.4 million people have left the labour force this year, which is why that falling unemployment rate is far weaker than it looks. 3 takeaways. 1. Bad news is good news, for now. This rally rests on a weak labour market, and that trade works right up until the data goes from soft enough to stop the Fed to weak enough to hurt earnings. 2. This is a delay, not a pivot. The 30-year yield is still above 5%. 3. Wednesday settles it. Our market mood index reads 6.5 out of 10. Risk on, but on borrowed time. Next week really comes down to one morning. July CPI, Wednesday, 8:30 Eastern. A cool print validates everything you have just watched, which opens the door towards 7,900 on the S&P. A hot one puts September straight back on the table and unwinds this move fast. Thursday brings PPI, and Friday gives us Michigan inflation expectations. Watch those closely. So, jobs cracked, the Fed blinked, and the records followed. Gold beat stocks, oil paid the bill, and crypto never turned up. Quick housekeeping. Everything here is research and education, not personalized investment advice. All data is as of the Friday, August 7th close, so verify live prices before you act. If you find this information useful, subscribe, hit like, and share this with someone who needs it. See you in the next video.